traders, welcome to part 1 of my series on how to read my charts. Today we're going to talk about the free indicators that I use on TradingView and how to use them. Let's jump right in. So the first thing that I'll note is the volume, which is on most people's charts, and it measures the number of shares traded in a particular instrument over a specified period of time. Then the next indicator worth noting is the RSI, that's the Relative Strength Index, and it measures the speed and magnitude of price changes. I use it specifically for identifying bounce points and oversold conditions. Next, let's take a look at the exponential moving averages that I use. So the orange line is the 8 exponential moving average, the turquoise line is the 12, and then the red line is the 20. And the 20 EMA is actually part of the Keltner Channels. And the Keltner Channels are a combination of an exponential moving average, which is the 20, I have set to the 20, I think it comes standard set to the 20. And then 2 average true ranges that you can set to a multiplier of your choice. And so I use 2, 2.5, and 3 depending on different market environments. So I'll show you. It comes set standard to 2, but if you take a look at, say we move it to 3, and you can see that, for example, when we saw this extreme move down last week, I moved the Keltner Channels to a setting of 3, because then typically when we reach the 3 ATR, price doesn't like to stay there for too long. You can see back here that price kind of rode the 3 ATR down, but that kind of opens the doorway to a conversation about the Bollinger Bands. So the Keltner Channels I will use with the Bollinger Bands, and that is a strategy that I learned from John Carter at Simpler Trading, and he uses the Bollinger Bands with the Keltner Channels to identify what he calls a squeeze, or it's a period of building up compression for volatility to follow afterwards. So it's like a tightening range. And so let's go ahead and put the Bollinger Bands on the chart, and I'll show you an example of where this is happening. So first of all, the settings on the Keltner Channel have to be 2, and the settings on the Bollinger Band have to always also be 2. And when you put both the Bollinger Band and the Keltner Channel on the chart together, what you're looking for is a period when the Bollinger Bands come inside the Keltner Channels like they did right here, and that builds up a high compression squeeze that John Carter calls it. And when the volatility is released from that squeeze, then you have a strong move in whichever direction it's released. I don't typically use both the Bollinger Band and the Keltner Channel on my chart at the same time, but I use it as a tool to identify squeezes. The Bollinger Band I use also for another purpose. Let's go ahead and hide the Keltner Channels and take a look. The Bollinger Bands are a simple moving average in the center, and I keep that set to 20. And that's different from the Keltner Channels, which is an exponential moving average of 20. So they will be a little bit different if you put them on the chart and you wonder why the 20 looks different on each of those indicators. So the Bollinger Band is composed of the simple moving average and an upper and a lower band. And the upper and lower band are set to the standard deviation from the mean. So you can increase that to 3. And this is the other function that I use the Bollinger Bands for. So when we're getting an extreme move from one side or the other, I will set the Bollinger Bands to 3, and then I look for price to actually touch or just ride that 3 standard deviation because that's a strong historic bounce point. I don't know of any instruments that will stay at 3 standard deviation from the mean for very long. As you can see here, they get close and then we bounce. We get close, we bounce. Here we get close, we bounce, same and same. So that's what I use the Bollinger Bands for. I do typically keep the Keltner Channels on my chart daily, and then I adjust that range in the Keltner Channel to either 2.5 is the standard that I keep it on there, but if we have a strong move, like for example here we had this big move down last week, and then our big move down the week before, and then the big move up last week. So I'll set that to 3, and I'll just leave that on my chart. Okay, next let's take a look at this little box up here. This is called symbols, highs, and lows. And what this tells us is you can select the tickers that you put in here. So let's open this up and I'll show you how this works. You can input 7 symbols. And so, for example, if I'm trading the NASDAQ, I'll actually put in there, like I'll put the S&P 500 in there, but then and maybe XLF, but then I'll fill it up with like FANG stocks, the Microsoft, Amazon, the top tech stocks. So you can pick your tickers that you put in there, which I think is great. And what it's going to show you is if all of those tickers that you've put in there are either at the high or low of the day at the same time, and by what percentage. And so for me, this is a great indicator because I trade intraday a lot, and I have a rule, which is that if all major sectors are hitting lows or highs at the same time, I won't be looking to trade Countertrend. Okay, now let's take a look at the pivot anchored volume profile. And we actually will shift over to SPY to take a look at this. And I use this again intraday. You can use it on the daily chart and it is effective, but I like to use it for trading bounces. So when, like for example, let's move back here. You can see here, we had this strong move down, and as price got down to where there were no sellers left, because this is showing you the volume over here, there's just no sellers left, price is going to have a bounce. So I kind of view this as like, this is the zone where there's a lot of buyers and sellers. This is the point of control. Here is the red line. And when we step outside of that, that's when we want to start looking for our bounce trades. I, again, don't keep this on my chart all the time. It's really just a reference point that I use when I'm looking for a trade setup. And last, let's take a look at the moon cycle indicator. This is a free indicator on TradingView, just like all the others. And this shows the full moons, the new moons, and the quarter moons. We've got the waning, the waxing and the waning quarter moons. And it also will show you the equinox and the solstices. This is a great indicator to use just to kind of keep you in tune with the lunar cycle. Price has a tendency to make the high of the period within 1 to 5 trading days around the new moon, and the low of the period within 1 to 5 trading days of the full moon. You can put this indicator on any instrument and you can observe how well that follows, how well that instrument follows the lunar cycle. And further, it's worth noting that sometimes the lunar cycle inverts, and so you can also see that when you're using this indicator. Again, I don't keep it on my chart all the time because I don't want to have a cluttered chart, but I do use it pretty frequently. So my charts typically look like this when I'm trading from one day to the next. And last but not least, I want to take a look at the paint the bars 1 and 3 Strat indicator that I use. So the Strat is a system developed by Rob Smith of identifying reversals, is specifically what I use it for. He delineated that there were 3 different kinds of candlesticks that can form. One is an inside bar, and with this indicator, the inside bar is colored white. The second kind of bar is a directional bar. That's a number 2 bar. So an inside bar is a number 1 bar in the Strat. A directional bar is a number 2 bar. And so those will be your standard red and green bars. That means that they move up one direction. And then we have an outside bar, which is the third kind of candlestick that can form. And that is a candlestick that breaks the range of the previous candlestick on both sides. So it's essentially will be a fake out. It's a move one way and then the other. Now, what I love about the outside bars is that oftentimes if you drill down from a higher time frame into a lower time frame, you can see that where there is an outside bar, there is oftentimes a megaphone pattern, and I really enjoy trading megaphone patterns. So let's take a look here, right here. This one is a good example. So we'll just drop our lines in there, and then we'll go drill down into the lower time frames. And if we drill down here into the hourly, you can see we will need to adjust that, but you can see that this formed a megaphone pattern right here. And I love trading the megaphones because, you know, it's not an even horizontal price level like some people really prefer, but I think that, you know, it gives you a range that you can be looking for a rejection on. And it's pretty clear whether it is going to stay inside that range and reject there. It's a low risk entry. And there've been a lot of them this year. This year has been the year of megaphone patterns. So that is it for my free indicators that I use on TradingView. I have a lot of other things that I use on my charts, timing tools. I use a software called Time Trades. That is a paid software, and it has indicators inside TradingView that I use. And I'll make a part 2 that's going to be about that. I'll put the link down below once that happens. One of the other things that you'll oftentimes see on my chart is planetary hours and planetary hot zones. And those are formed. Let's take a look at the SPY chart. So those are formed by using the planetary hours that I manually apply to my chart. And actually there's a link in the video description below on how to do that. I made another video about that we're not going to get into today. But just to give you an idea, you may see something like this on my chart, and that would be where those lines come from. They would be coming from me marking the moment of price, the price action at a moment of time based on planetary hours. That's a wrap for today. Don't forget to like and subscribe. I hope you have a successful trading week.